you everyone for joining our very last live Q&A session of 2024. It's hard to believe that the year is almost over, but my name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. Today, I'm here with Brett Synicky, and he'll be answering all of your questions. As I mentioned before, if there are additional questions, please type them up in the Q&A section. But just briefly want to introduce Brett. Brett is our solo 401k and self-directed IRA consultant here at Sense Financial, and he has a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Thank you, Brett, for joining us today and taking the time to answer the questions.
All right. Yes. Thank you, Natalie. Can you hear me okay?
Yes, sounds good.
Awesome. Good to see all your names. Appreciate you being here today. And as Natalie said, definitely please type in your questions because we have a bunch that we'll cover, but we should have some time at the end to get to some questions that you put in during this call.
Okay, we'll jump right in. First question we have here is from Crystal, and she's asking how to sign up.
Yeah, Crystal, thank you for the question. So anytime somebody is ready to become a client, all we need to do is hop on a call, and usually takes between 5 and 10 minutes, depending on how many questions need to be answered. But assuming you've already done your due diligence, maybe you've probably already had an official consultation with somebody from our office, then another phone call will all it takes. A few minutes on the phone, get some information from you, process the order, and then you'll be off to the races. Now, as far as the process goes after that, it really depends on whether you do a solo 401k or a self-directed IRA. And just briefly, the solo 401k takes about 4 days from start to finish to set up. That doesn't necessarily include any existing retirement funds that you might roll in. That can, depending on the custodian that they're coming from, that can take a little bit of additional time. But inside of about a week and a half or 2 weeks, you are the pacing factor on things that we ask for and steps that need to be taken. But assuming you pull the trigger really quickly on things we tell you to, inside of about a week and a half or 2 weeks, you should have the entire plan set up, checking account, and the money that you wanted to roll over, if any, already in there, ready to self-direct. As far as the self-directed IRA, it's a little bit of a different process. It takes between 3 and 4 weeks to get fully set up, and that includes the rollover from any existing retirement accounts. So thank you, Crystal. Good question.
Next question here is from Yulia, and she's asking, I have a 401k with my prior employer. Can I create a solo 401k? Do I need 1099 or business to do solo 401k?
Yulia, thank you for the question. Solo 401k does require what the IRS says is legitimate self-employment activity. That's a very broad term because you don't need actually a 1099. You just need any sort of self-employment activity. So what I mean by that is you could get a 1099, right? As a real estate agent, if I sell a house and I get commission for it, my brokerage at the end of the year sends me a 1099 for the income that they paid out to me. Okay, so that's self-employment activity. Now, beyond that, I could be a sole proprietor. I could be I could have that money paid to an LLC. I could be, and then filing as an S corp. I could be an LLC. I could be a C corp. Really, any type of legitimate self-employment activity will qualify you for a solo 401k. Now, regarding the 401k you have with your former employer, that's really irrelevant to qualifying for a solo 401k. But since you brought it up and you have it, that money is eligible to roll into as a direct rollover. This is a tax neutral event into the solo 401k. So that's something you could roll all of it, part of it, totally up to you. There's no limit to rollovers, by the way. Just you can do one today, one next week, one the week after. None of that creates taxes, just a little bit of extra work for you and maybe some wiring fees if they're applicable. But other than that, there's no limit to rollovers. Now, it's important to note the Roth IRA is the only type of qualified retirement account that cannot go into and roll into a 401k. If it's a Roth 401k, that's okay. Roth 403b, that's okay. It's just the Roth IRA, if you want to self-direct, would have to become a self-directed Roth IRA. It could not move into a 401k. So hopefully that answers your question, Yulia. Thank you for it.
This question is from Paul. I have a self-directed IRA. Is there anything I need to do at this time?
Yeah, Paul, thank you for the question. Appreciate it. It is the end of the year, so there are some things to do for both the self-directed IRA and the solo 401k. And so I will, if you will indulge me, everybody on the call, I'll spend a few minutes talking about this since it is kind of a timely subject. So first of all, for the IRA, if you have an IRA LLC, there may be some state requirements, the tax that's due. You need to check with the state that the LLC is actually filed in to see if there's any specific requirements. Definitely recommend you check with your CPA on that as well. Any address updates, just this is the time to get that updated. If you are living in a state that the LLC is, and the LLC is actually filed or was created in a different state, you need a registered agent or a third party out there, unless you have an address you can use. But most of the time that scenario calls for a registered agent. So now would be the time to look into renewing that service if you didn't already pay for multi-year service. And then additionally, for the IRA, the custodian will actually contact you in December, so it should be coming shortly for the valuation. This is the form 5498 that would need to be completed and sent out. So you'll need a value of the sum actually of all the assets within the plan. Okay, so for real estate, don't overcomplicate it. Just an estimate from Zillow can work. Okay, you don't need to go pay $600 for an appraisal. If you have like a syndication investment, you can just ask the operator of the syndication for a rough value of your investment. Okay, so all the cash and all the investments would be part of this valuation. And then of course, contributions. If you're going to make a contribution, now's probably the time to consider it. Now, again, check with your CPA, but you should be able to contribute to the IRA up until you file your taxes. So you don't necessarily have to do that before the year is over. So those are the kind of some bullet points as far as the LLC goes, the IRA, excuse me, the IRA LLC. The and if you're an IRA trust client, actually everything applies with the exception of the LLC stuff, right? Because the trust is not actually registered with a state anywhere, but the contribution and the valuation, all that still applies. Now, regarding the solo 401k, little bit of a different topic, right? The contributions work a little bit differently because they're based upon your self-employment income. So you're going to want to calculate properly, prepare for, depending on your business type, making contributions into your plan. Now, if you're an S Corp and you're doing payroll, it's best to do these contributions in 2024 through payroll as far as the elective deferral goes. If it's the profit sharing, you can do that all the way up until you file. If you're a sole proprietor, then you should be able to make both of those contributions, the profit sharing and the elective deferral, up until you file. Again, double check everything with your CPA, not only the timelines that I'm mentioning, but also the contribution amounts. I want to make sure you don't over contribute or under contribute for that matter. And then if you are going to do any sort of Roth conversion, if you have that planned, there's a document that you're going to want to fill out for your records and for your CPA's records. Of course, a 1099 would need to be issued. Speaking of which, if you are going to do a 1099 and you are a client of ours, reach out to us before January 10th with the request for those 1099s, and we don't charge anything for that. Now, if you do it after January 10th, or you're not a client of ours and you're asking us for help, we do have a small fee to cover that. So just be timely with it. And, there's no charge for those 1099s. And 1099s will come into play if you do a distribution, a Roth conversion, If you do a profit sharing conversion as a Roth contribution, that will apply as well, because it's actually a pre-tax contribution, and then you convert it to Roth immediately. And so a 1099 is generated to account for that being added to your taxable income to make it Roth funds. If you are required to do RMDs, this is 73 years old or more, this would apply to the IRA as well as the solo 401k, with some differences there, but the you're going to need to check with your CPA to calculate your RMD amount. And I think we have an RMD question here in a little bit, so I'll wait to dig into the weeds on the RMD for that. And then just record keeping, make sure you're keeping proper accounting. Your responsibilities are, as the fiduciary of your plan, the plan administrator of the 401k, is to keep proper records, bookkeeping records. You're going to want to keep a spreadsheet or use QuickBooks or Quicken or something like that, just to balance the checking account, keep track of the transactions, incoming and outgoing, and then of course all the investments. And you're going to want to know how maintaining this 401k, contributing to it, of course, affects your personal taxes. Again, I'm saying all this with the caveat of get with your tax advisor. And then the last thing for the solo 401k is the 5500 EZ form. This is required by the IRS if you are over $250,000 of total plan assets. So this is the cash and the investments, is required at the end of the 7th month after the plan year ends. So 99% of the plans have a December 31st ending each year, which means that the deadline for filing the 5500 is July 31st, 2025. You don't need to wait until July 29th to do this. You can do it as soon as the year is over. We do recommend that you file this regardless of whether you have 250,000 of total plan assets or not, for a few reasons. One, it's a really good way to just get a picture of the value of your plan, and that's good to track. And then two, the first time you do it is the hardest. After that, you just have to update some of the numbers, so it's easier. And three, and probably most important, is it actually, as we understand it, starts the statute of limitations on how far back the IRS can go for audits. Now, don't get scared with that. Audits don't happen a lot within 401k plans or self-directed IRAs. It's generally if someone does something stupid like a prohibited transaction that causes said audit. But nevertheless, we want to start that statute as soon as we can. And the 5500 for the solo 401k actually starts that. So sorry for the long-winded answer, but I wanted to take advantage of the time of year and the question. So thank you.
Next question here is from Chris. I want to discuss whether the Sense documents allow for the Mega Roth conversions, etc.
Yes, great question, Chris. Yes, they do. You can do Mega Roth conversion. You can do Roth conversion anytime. You could do Roth contributions. As far as, now I'm talking about the solo 401k. If it's a self-directed IRA, it's either a traditional self-directed IRA or it's a Roth self-directed IRA. You can have both, but they are separate plans. Within the solo 401k, it has a traditional pre-tax component to it as well as a Roth component to it. So it's already in one plan. I do want to talk about the Roth conversion for a second. Something that people need to consider when building up a Roth style account, especially within the solo 401k and the IRA actually too. It's just they're two separate accounts, as I mentioned, is this. If you do a Roth contribution or you convert traditional funds, cash, to Roth funds, cash, you are basically taking that money dollar for dollar and adding it to your personal tax return. It's going to add to your taxable income. So whatever your tax rate is, talk to your CPA. That's what's going to be paid on that dollar amount, right? So if you do a Roth conversion of $100,000, it's going to be $100,000 that's added to your taxable income for that tax year. Okay. Now, something to consider is you can actually not only can you convert cash, but a lot of people don't know this, you can actually convert assets. And so what I mean by that is, let's say you have a rental property. Actually, let's say it's a trust deed. So you invest in a trust deed, call it $50,000. This is a real life story, by the way. $50,000 trust deed. You can go, you have to, IRS requires a third party valuation. We have one of those companies on our website under resources and recommended vendors if you want to check them out. And so you go to this third party company, they will do a valuation for you on this note. Okay, it's a $50,000 investment. They'll value it at a certain dollar amount. You want to do a Roth conversion on this. So whatever they value it at is the amount that's going to be added to your taxable income. Okay, so this is a really cool way to kind of hack getting more money in the Roth and paying less in taxes. So here's the real life scenario. $50,000 trust deed. This is an extreme example, but I'll give another real life example as well. That's not so extreme, but this can happen. $50,000 trust deed goes in default. Okay. Notice of default is filed, excuse me. Borrower is about 3 months or so behind in their payments. And so this client goes to the valuation company and says, here's the address, here's the note. They're behind in their payments. We already filed a notice of default. Give me a value. I want to convert this to Roth. Okay, remember, it's a $50,000 payoff. Foreclosure process has already started simply by filing the notice of default. We don't know whether the borrower is going to become current or not, or if the foreclosure is going to go all the way from start to finish. That remains to be seen. Here's the point. The valuation company valued this note at $21,000. Okay, over 50%. That's like almost 60% discount. So this client's going to add that $21,000 to their taxable income, but the total value is actually 50 plus all the interest. Plus, it gets even better if, now, we don't necessarily recommend you loan to own, but it could happen. If it goes all the way to foreclosure, this property is worth between $300,000 and $330,000. Then potentially this client, their 401k, could get the entire $300,000 property and in Roth, by the way, no taxes ever after retirement from a distribution perspective. And they only pay taxes on $21,000. So that's the power of converting an asset over just cash for cash or making straight Roth contributions. In fact, knowing this, I think people need to examine whether it makes sense ever to do a straight Roth contribution, because you can take this, you can do a pre-tax contribution, save on taxes today, invest in an asset 6 months from now, do that valuation, and it 99.9% of the time comes in less. Let's say it's not in default. It's still going to be a 30 to 35% discount, and you're still going to pay taxes on, 40 maybe instead of 50. And so it's still $10,000 less in taxable income to convert the same amount. So sorry for the tangent again, but I wanted to say that. So thank you for indulging me.
This question's from Dominic. I have a self-directed Roth IRA and I invest in cryptocurrency. How can I withdraw?
Yeah, Dominic, I see you're on the call. Thank you for joining us and thank you for submitting the question. I'm a little bit confused about what you're asking. Are you talking about withdrawing money from the IRA, or are you talking about drawing money from the crypto exchange or cold storage and then putting it back into the IRA directly into like the checking account? I'm just a little bit unclear on what you're asking. So if you want to type into the chat to clarify, I'd be happy to address it further. Of course, if it's coming out of the IRA, whether it's an investment or cash, it's the same thing. It's a distribution. So if you're over 59 and a half, then you can do this distribution, but if it's pre-tax money, you're going to pay your tax rate on it. If it's Roth, of course, there is no taxes on it as long as you're over 59 and a half. But yeah, just clarify if you can.
Okay, next question is from, excuse me, Donald. I have a self-directed IRA with you using a trust. Do I need to file for the CTA?
Yeah, Donald, good question. You're asking about the beneficial ownership information reporting, BOIR for short. No, that's only for LLCs, for corporations. So you don't need to worry about that with a trust. Thank you for that question. And anybody who has an IRA, actually, I think we sent the email out to all the clients, but if you have an IRA LLC, you would need to file that.
Rohit is asking about the eligibility criteria for 2024 and backdated eligibility to 2023 and income proof.
Yeah, Rohit, we probably need to jump on a call. This is somewhat of a unique situation. I would certainly need more information than we can probably cover here, and even if you do put something in the chat. So let's jump on a call together and talk through that, and be able to give you a little bit more direct help.
Next question is from Teresa. If I perform a Roth conversion within my solo 401k, does Sense Financial help with the 1099-R?
Yeah, and Teresa, thank you. Good to hopefully you're actually on the call. But yeah, thank you for the question. Actually, I don't see her, but that's okay. Teresa, we covered that just a few minutes ago, but just again, I'll say it again in case you don't hear it or didn't hear it. The 1099-R is something that we can help you with in that situation. Just get to us the request before January 10th, and there's no charge for that at all.
Okay. We do have a clarification from Dominic, so we'll go back to that question. So his original question was, I have a self-directed Roth IRA. I invest in cryptocurrency. How can I withdraw? He clarified that I retired now. I want to withdraw money from my self-directed IRA for monthly expenses. I have an account with Citibank.
Okay. So the crypto is kind of irrelevant to the question, if I understand correctly. So I'm not sure where the crypto part fits in. But Dominic, if you want to do a distribution to yourself, you need to contact the custodian. So if you're a client of ours, then go to you probably have Solera or Forge. Just contact them, and they'll help execute that distribution for you. The money, if you have a IRA LLC or IRA trust, you have to move the money, the fund or the assets if you want to distribute an asset to yourself, but you have to move it from the LLC or the trust back into the custodian, and then that's where the distribution has to take place, but it has to go through the custodian.
Okay, next question's from Thao. How to qualify for EQRP? And then he's also asking about EQRP versus Solo.
Yeah, great question, Tao. I really appreciate it. I don't We are not specialists in EQRP. It's not something that we offer. However, as I understand it, the EQRP and the Solo 401k are very similar. In fact, what you can invest in, the annual contributions, Roth and traditional, self-employment requirement, it's all the same. I have read something where EQRP may, in capital letters, work for people with businesses with employees outside of their spouse, but don't quote me on that. Again, this is not our specialty. Um, the other thing is somehow EQRP is part of ERISA law, which protects 401ks and employer sponsored plans from creditors. The solo 401k is not under ERISA law. It's actually set by each state as far as creditor protection. And I think there's only 2 states that are kind of funky with that don't have preset creditor protection for the solo 401k. And I am not going to say the states because I don't remember for sure which 2 they are, but they're somewhere back east. And I just don't remember off the top of my head. But that would be probably one of the primary differences that I had read. And the EQRP cost is, if again, this is all if I understand correctly, is a few $1,000s versus a few $100s for the solo 401k. So they're quite a bit different from that perspective as well. Hope that helps, Tao. Happy to jump on a call and talk further.
John is asking how to calculate RMD with an IRA, which is 88% post-tax contributions.
Yeah, good question, John. As I'm sure you already know, the Roth money that you have is 88% post-tax. So this is Roth you're talking about. Well, there's no RMDs on Roth, so 88% of this money would not be subject to RMDs. So your 12% would be subject to RMDs. So there's a calculation. There's calculators like Charles Schwab has a good calculator for RMDs to give you an idea. But ultimately, you're going to want to check with your tax advisor how much RMD you actually have to take, and then those, just like any other distributions, would have to go through the custodian. So hope that helps.
Next question is from Katrina. My solo 401k funds, are they FDIC insured? Is the account in my name alone?
Um, the account in your name alone. I'm not sure what that part means, but the checking account is at a bank, and that bank, just like Wells Fargo or B of A or Chase or any other bank that I'm aware of, uh, has FDIC insurance up to $250,000 per account. Now, let's clarify per account. The solo 401k plan, let's call it Natalie 401k plan, is the account owner. Okay, so if you have multiple checking accounts within there, which you probably will, because you need to separate the types of funds, right? Profit sharing, um, elective deferral, Roth, traditional, these need to be separated. They're all, even though they're separate checking accounts, they're actually all under the same account. So it's $250,000 per, they call it per relationship. The relationship is with the account owner, which is the 401k. So per relationship is a total of $250,000 of plan assets. Now, if you're a solo 401k client with us, it's very likely that you have that account at Titan National Bank, and Titan has a way of spreading out this money if you have $1 million in there. By the way, real quick, these are just holding places. They're not designed to have a ton of cash in for long periods of time. So FDIC insurance over 250 probably shouldn't be a large concern, because the idea is to deploy this money and invest it, not keep it in a checking account earning like 0.6 or 0.06, I can't remember, percent interest rate, which is almost nothing really. But I digress. The Titan actually has a way of spreading out. If you had $1 million, they can spread out $250,000 by 4 different banks, but have it be in your same account. So they do all the work for you. They open it, literally is 4 different banks, but you have one login at Titan and you can see all your money in there. But in the back end, your 250 is spread out 4 times to get all of that FDIC insurance. And they have a term for it. I can't remember what it's called. It's kind of a unique word or term that, we don't use every day. So I don't remember the name of it, but that's how they kind of get past the 250 limit. But the simple answer, Katrina, is yes, those funds are FDIC insured inside of that checking account. And then if you have any information, Katrina, if you're on the call and you want to clarify what you mean by is the account in your name alone, we can circle back to that.
Next question here is from Kanaz. Can the solo 401k trust join in as an investor with other partners on something like a franchise?
Yeah, thank you, Kinos, for that question. Good to see you and see your question as well. Yes, it could. Now, bear in mind, a retirement account is designed to be invested passively. And so if you're going to be a private lender in the form of a limited partner or just a lender in a franchise or in some kind of apartment syndication or whatever it is, that's fine. That's a passive activity. That's what it's designed to be used for. However, if you are going to be a general partner, not you, if the 401k or IRA is going to be a general partner in a business, you're now a business owner, or the IRA or 401k is now a business owner. And so to level the playing field between somebody personally running a business and paying all the taxes that come along with that, the IRS says, well, we can't allow people to do the same thing in their retirement account and not pay any taxes, because that wouldn't be fair to, mom and pop down the street running their business. Well, so they implemented what's called a UBIT tax, unrelated business income tax. It's unrelated because, again, it's not designed to be used to run a business in. It's designed to be invested passively. So to answer your question, yes, you can do this. It's not a prohibited transaction, but two things. One, you have the UBIT tax to consider, and two, you can't be involved. You can't perform services. You can't go sit in board meetings and make decisions for the company and help run the business. I mean, technically, you could do like some white collar work behind a computer and make some decisions, but you can't be like a hiring manager. You can't be involved in the day to day. You literally have to outsource everything pretty much, or else that would be a prohibited transaction. And so you can't get paid for it personally. You can't work for it. You can't do any of that. So it's best to just not run an active business. Although I will say, we do have clients who have Solo 401k as an example, who are actively using it to fix and flip real estate, which is an active business. They're totally hands off. They hire everything out to a general contractor, another real estate agent who sells it, represents the transaction on both sides, totally hands off, no prohibited transactions going on. And they are paying that UBIT tax on the profit they're making from fixing up and flipping these houses. They say it makes sense. The numbers make sense. I don't know if they do. They've penciled it out and it does. So it's up to you. I probably wouldn't do this.
Okay, those were all the questions that were submitted ahead of time. We will move on to questions in the chat. We do have a question here from Chris that we actually answered earlier. Question from Kinos. Can you explain profit sharing as it pertains to the solo 401k contributions?
Sure. Yeah. So, Kinos, profit sharing is, so the Solo 401k has two separate contribution buckets, right? As remember, the Solo 401k has a self-employment requirement tied to it, right? So being self-employed, you wear two hats. You are the employee and you are the employer. And because of that, the IRS allows you to make both types of contributions. One is the employee and one is the employer. The employer contribution is called profit sharing. For 2024, the maximum between the two, but you don't have to do both. I'll explain that in a second. The maximum for a solo 401k plan is $69,000 if you're under 50, and if you're 50 plus is 76,500. So two different hats, two different contribution buckets. The elective deferral is 23,000 with a 7,500 catch up if you're over 50. So 23,000 or 30,500. And then if you max that out from the income from the self-employment, right? It has to be income from the sponsoring business of the 401k plan. Again, you as a sole proprietor, an LLC business you're running, S corporation, we'll set up the plan under whatever entity you tell us to, okay? But the income that is derived from the business in that entity is what dictates the amount of contributions you can make. So for sake of conversation, let's say you make enough to max everything out. So you have the elective deferral, again, 23,000 under 50, 30,500 over 50. And then on top of that, you have profit sharing, which is roughly 20%. It varies a little bit based on S corp versus sole prop and single member LLC, but it's either 20 or 25% of the profit of the company or of the total payroll for the year. So if you're an S corp running payroll, the total W-2 for the year, you can contribute 25% of that. Okay, if it's $100,000, you can contribute 25,000 on top of the elective deferral, the 23 or the 30,500. Now, on the sole prop side, it's 20% of the roughly 20% of the gross profit of the company. You have to subtract some things, but the earned income after it's all calculated out, 20% of that. Okay, so both of those can total up to 69 or 76,000. Now, if you're maxing out a W-2 401k, then you don't have to, you don't actually have to, you cannot actually um, double dip on the elective deferral. So if I'm 45 years old and I'm putting in 23,000 in my W-2 job, I can't also contribute anything because I'm already maxed out at my solo 401k from my self-employment on the elective deferral, but I can still make the profit sharing contribution. Okay. And I can go all the way up to $69,000 with 25% of my payroll for profit sharing if I pay myself enough money for the year to get to that maximum amount. So hopefully that makes sense. Now, a couple things. One, both of those contribution buckets can be made as pre-tax or Roth. Rewind this call back about 20 minutes and listen to my rant about why it may be better to convert assets to Roth instead of making straight Roth contributions. But I just want to make sure you know you can contribute both of those Roth, one or the other, part of one, part of the other. It's totally up to you. And hopefully that answers your question as far as profit sharing. You probably got more than you bargained for, but that's the answer there.
Another question from Kinaz. What is Mega Roth?
Well, Mega Roth is a way to get more money into your IRA as Roth if you are, well, two things. You've probably heard Mega Backdoor. That is if you are making more than the limit per year that the IRS. So if you make, I think it's like 270,000. Don't quote me on that. Married filing jointly of income for the year, then you cannot contribute to a Roth IRA. There is no limit like that. There's no income limitations on the Roth 401k, whether it's an employer sponsored plan that you're working for somebody for or a solo 401k. It doesn't matter. You can contribute. There's no need to go through the back door to do that. You can go right through the front door. Okay, so that's one way to do the Mega Roth. The other way is you can actually make after tax contributions into your solo 401k. It's a different type of contribution. It's still subject to the same $69,000 limit, but it's a different type of contribution. And so you can make, if you're not making enough on your business to max out the money at 20% or whatever of the profit sharing, you can actually make what are called after tax contributions. And so basically you would pay the taxes on that money, of course, and put it in. It's kind of like a Roth contribution, but it's a little bit different because it's not going straight in as Roth. You're actually going to do what's called an after tax, and it has to be a separate account at the bank called an after tax. And we have instructions, clear instructions in our client portal on this that I can share with you if you'd like. Just reach out. And so you open up this account, you fill out a form to indicate you're making this after tax contribution, and then immediately you would do a Roth conversion on that money. And the reason you want to do it immediately is because any gains on that money are going to be subject to taxes. So if you do an after tax contribution of $20,000, then and you convert it 5 days later and now it's $20,500, well, you're going to pay taxes on the 500. So you want to do it as quick as you can. Okay, so that's how the backdoor or mega Roth contribution kind of works roughly. You can double check our client portal again for more detailed instructions on how to do that. But again, it's, I think, just really consider converting the asset instead of going straight Roth contribution, since it'll save you on taxes. So hopefully that helps.
Okay, we do have one more request from Kinaz. Please send those two state names to us via email if you don't mind.
He's talking about, go ahead.
I think it was the RMD question, if I remember correctly.
No, he was asking about the EQRP, and I mentioned
okay.
that there's two states that are kind of funky with the what's it called, with the the creditor protection.
Mm-hmm.
Go ahead and ask the next question. I'll get the answer here before we get off this.
Those are actually all questions
Okay,
for
so bear
today.
with
We'll
me for
see.
like 30 seconds because I want to
Yeah.
get these answers.
If there are any other questions, please type them up. Be happy to answer them.
Yes, indeed. So I am logging into our client portal.
Mm-hmm.
I just have to remember the right keyword to type in. Let me see. Okay, here it is. All right, so yeah, we have all the states listed out. Michigan and Rhode Island. And that's it. Every other state offers creditor protection. Some of them have, up to $1 million. Like some of them have 100% except for amounts contributed within 1 year, including rollovers, contributed in excess of 15,000. So anyway, there's some details on some of these, but most of them are just a straight up yes. So anyway, hopefully that helps.
Mm-hmm.
All right.
All right. Yeah, those were all the questions. Thank you again, everyone, for joining us. If there are additional questions, please reach out to our office. We'd be happy to either set up a consultation or give you a call to answer those. Thank you for joining. Brett, do you have anything else to add before we wrap up?
Nope. Thank you very much for joining us, and just I guess only reach out if we can answer any further questions outside of this anytime. You don't have to wait till next month.
Yes. Okay. Thank you, everyone. Have a great day.
Thank you, everybody.